You know what I'm talking about then? Okay, let's just get this recording going. Right. Well, thanks for coming along to the launch of IDEAEconomics for Asia. What I want to talk about is really the context of why we're trying to change the nature of economics and what is the current state of economics. And I can argue definitively that it ignores the cause of the crisis. It didn't see the crisis coming. Whatever it was looking at back in 2007 clearly didn't include what caused the crisis, because the forecast that conventional economists were making at the time literally was saying that their expectations about the future for the economy were quite benign. That's a phrase that we used in the OECD Economic Outlook for June 2007, saying their forecast looks quite benign. And just to show there's no originality in economics, exactly the same phrase was used in the December 2007 minutes of the Federal Open Monetary Committee, saying that even after the crisis had begun, because it was regarded as starting in the beginning of August 2007, when BNP shut down 3 of the funds that that were linked to the American subprime market. So you're already 3 or 4 months into it, and again, their discussion about their economic forecast, quite benign. So they did not see the causes coming. And I, as has been pointed out, I focus on the importance of private debt. And so did somebody called Irving Fisher back in the 1930s, after he'd failed to focus on the role of private debt in the 1920s, I might add, and went bankrupt effectively during the financial crisis of the 1930s. But after he looked back and saw, what did he get wrong, he developed what he called the debt deflation theory of the Great Depression. Now, you'd imagine if you were regarded as a global expert on the Great Depression, you would have paid some serious attention to Irving Fisher's views. And the person I'm quoting from here got the job he just recently retired from, because he was regarded as a global expert on the Great Depression. And what he has to say is that Irving Fisher gave us the idea of debt deflation, and his diagnosis led him to urge Roosevelt to reflate the economy rather than worry about the exchange rate. But he said, but his theory was less influential in academic circles because of the counter-argument to debt deflation, that it's no more than a redistribution from one group, debtors, to another group, creditors. Now, obviously, we know we're not talking about a banker here, because a banker would know that when the debt deflation occurs, the debtors don't pay their debts back. It isn't a redistribution. So it couldn't possibly be a banker, could it? Oh dear, it's a central banker. Okay? And his argument was, starting from the premise that the debt deflation is no more than a redistribution, which of course ignores the impact of bankruptcy to begin with, he then says that without huge differences between lenders and debtors and creditors, pure redistributions should have no significant macroeconomic effects. Then, of course, the person who now is regarded as the real expert on the Great Depression and on the crisis we've been through is Hyman Minsky. So obviously you'd imagine Hyman Minsky was paid attention to, because so many American economists who are conservative economists, they call themselves New Keynesians. I think they're the new nor Keynesian, but that's another issue. But they now call themselves Minskyites, which I find quite amusing. Well, here's the same person, Ben Bernanke, talking about the alternative theory to the one he was developing. His theory, by the way, blamed the Federal Reserve for the Great Depression, which I found quite ironic, since he became the chair of the Federal Reserve during the next crisis, like the Great Depression. But talking about Minsky, he said, Hyman Minsky and Charles Gundelberger have in several places argued for the inherent instability of the financial system. Looks like a pretty sound argument these days, doesn't it? He said, but in order to do so, have had to depart from the assumption of rational economic behaviour. And on that basis, in a footnote, he continues, he doesn't deny the importance of irrationality, but it seems the best research strategy is to push the rationality postulate as far as it will go. That's the entire consideration that Ben Bernanke gave to Hyman Minsky in his book Essays in the Great Depression. So we're ignoring alternative theories because you don't understand them. Well, pure redistributions, as he said, should have no significant macroeconomic effects, which would mean that if I tried to correlate changes in the rate of growth of debt with any macroeconomic variable, I should get a correlation of roughly 0. Okay. I've been hawking this chart around now for about 8 years. I'm still waiting for any neoclassical economist, or any other one unfortunately, to do the proper econometrics for me. Now, Paul tested your ages and memories a bit a short while ago, talking about Carson and the Silent Spring. Does anybody remember what a Rorschach test was? Anybody do a Rorschach test? Okay. That's, the correlation there is so overwhelmingly obvious that it looks like a Rorschach plot to me. The correlation is minus 0.93. Now, I don't call myself a statistician or an econometrician, but I've got a feeling minus 0.93 is significantly different from 0. What do you reckon?
On a scale of 0 to 1.
That's right. The maximum it can be is minus 1. That's a ludicrous correlation between two factors that conventional theory says shouldn't have any relationship with each other. That's the sort of thing which is being ignored by the mainstream. What they're doing is they're ignoring what they can't explain. And this is, I saw a classic, a colleague sent me a quote from Kahneman, the psychologist who won the Nobel Prize for Economics, who introduced behavioural economics. And he talked about what he called theory-induced blindness, and said he saw himself as being guilty of it occasionally. Even if the facts contradict your theory, you defend the theory. And he said he regarded himself as guilty of it as well. But that's fundamentally what's going on with economic theory. They have a set of theories that the facts contradict, and they either ignore the facts that contradict it or reject them without considering them properly. What they've been ignoring is this growth in debt in America over the last 1.5 centuries. And the one I worry about most is the red line, which is private debt. But you can see, with all the cycles, a tendency for a rising level of debt on the economy over time. Okay. Big crises, big drops, of course, back in the 1930s. A bit of a drop now, with private sector deleveraging more than outweighing the increase in private debt. But overall, a trend for a rising level of a more debt-encumbered society, and we're wondering why we're having a hard time managing the system. So this is the theory-induced blindness that means economists don't look at debt and don't look at banks, which is quite remarkable. I mean, most people who don't do economics think economists are experts on money, because that's what they think an economist would study. What, of course, you learn as an economist is why you should ignore banks, debt and money. Right from the very first lectures in first year, they talk about the economy being a real phenomenon and money being frippery, the stuff that determines the rate of inflation, not determining real output. And I think this is a wonderful statement from somebody with rather more wisdom than Ben Bernanke. This is Mark Twain, saying it ain't what you know that you don't know that gets you into trouble, it's what you know for sure that just ain't so. And that seems to be the nature of economic theory. So here's another famous conventional economist talking about people like myself, saying that self-proclaimed Minskyites view banks as institutions that are somehow outside the rules that apply to the rest of the economy. And he says he doesn't see it that way. Banks don't create demand out of thin air any more than anyone does by choosing to spend more. And banks are just one channel linking lenders to borrowers. He said, this is Krugman, saying he expects to get the usual barrage of claims saying that he doesn't understand banking. He says, actually, I think I do, and it's the mystics who have it wrong. So call me a mystic. Okay? I'm about to explain why I think there's a difference. Now here he goes again in one of his other books, or I think it's like the same, in his book, Stop This Depression, We're in This Depression Now. He says, think of it this way, when debt is rising, it's not the economy as a whole borrowing more money. So there's no relationship between change in the level of debt and the change in the level of money, okay? That's what his proposition is making there. He said it's just a case of less patient people borrowing from more patient people. And one thing I find amusing about economics is that neoclassical economists invented this whole idea of what they call normative economics versus positive economics. Normative is where you make value judgments, and positive is where you don't make value judgments. And they think they do positive economics, so refrain from any value judgments. Who's the good person, the patient person or the impatient person? The very language they use is pejorative. Okay? Perfect this versus imperfect that, etc., etc. So there's pejorative terms built into this so-called normative logic.
An impatient person or a lender.
Yeah, indeed. Okay. Now here's the vision he has of lending. The banks the banks is where the money is stored, so nothing actually happens on the asset side of the banks. And the patient person lends to the impatient person. The impatient person pays back the loan, the impatient person pays interest, and the patient person pays the bank a fee for arranging the loan. That's the vision they've got. Well, the real world, and I hope I don't need to explain that to most people inside this room, since I'm not talking to a room full of economists, is that banks make loans. So while I've just rearranged a few of the froms and twos and I've knocked off the bank fee, which is irrelevant in this situation. Yes, there's some sort of lending like that, but mainly it's banks. Banks lend to the non-bank public, the non-bank public pays the debts back, and the non-bank public pays interest fees to the bank, so the bank's profit comes out of the interest payments. Now, does it make any difference? Well, one thing I've done with the assistance of both the public and the Institute for New Economic Thinking is build a software package that enables me to model monetary flows that I call Minsky, in honour of Hyman Minsky. And what I've done with that model in this particular model is I've built Krugman's model, and when I simulate it, I find that changing the level of debt is actually, as he thinks, unimportant. So if I run this model now, I'll just show you the banking sector that I've got inside here. It's got exactly the structure I've shown you: lending, repayment, interest payments, and paying a fee. And then the rest are hiring workers, workers consuming, bankers consuming, bankers investing, etc., etc. So it's exactly the model I've shown you there in a stylised outcome. And if I run this model, notice the growth rate stabilises. Hang on, which one have I got here? I'm just checking. Yep, that's right. Okay. The growth rate is 0. If I increase the rate of lending, the growth rate actually falls. If I make repayment take much longer, so loans stay in circulation longer, the growth rate falls again. Drastic change to repayment, a bit of a boost there as people repay loans more quickly. Another boost when lending slows down dramatically. But I'm making enormous changes to the level of lending and everything else there, and the growth rate is stuck around 0. If I just stop the model for a second and make it a bit smaller, because the screen resolution here is a problem, I've had dramatic changes in the level of debt. No change in the level of money, which is part of the argument that he was making beforehand. And I'll just push my luck a bit further with the resolution here and try to move down. And there's the debt ratio, which has varied between 0 and about 70% of GDP and back down again. Huge changes in the debt ratio, no change in GDP. So his argument, if he was institutionally correct about the nature of lending, yeah, you could forget about banks, debt and money, which is what they do. Now, what I'll try doing in a moment is modifying that model to say that what I showed you, the second table, applies. I think you can see the difference between GDP flatlining over here and GDP rising over here. Okay? Changing the amount of money, changing the amount of debt changes the amount of money for the reason Paul mentioned earlier. When a bank makes a loan, it says, that's a great idea, here's $1 million, which is a deposit in your account, and you owe us $1 million, which is their asset. So the creation of loans creates deposits and increases the money supply. And I can actually demonstrate that nice and quickly in Minsky. It's always a risk to do this sort of stuff live, but I'll give it a try. I'm going to delete, the way the system is set up at the moment, it shows the debt as being an asset of the patient agent, who in this case is the consumer sector. Now I'm going to say, well, that's nonsense. It's not an asset of the consumer sector, it's the bank that does the lending. So I just knock off the rows here that relate to the lending, the fictional lending arrangement that people like Krugman believe applies in between patient and inpatient agents, and make it actually the bank that does the lending instead. I can come up here and say, well, let's now make that asset an asset of the bank rather than pretending it's an asset of the consumer sector. The interest payments go to the bank. Delete this silly idea of a bank fee, and then change lending as being based on the current level of debt rather than being based on the deposits of the consumer sector, which is their basic model. Run the same system again, and you'll notice that growth rate remains positive as we keep on going. Notice the money supply is rising. If I then have an increase in the rate at which lending occurs, the growth rate increases. If I have repayment happening more slowly, so people keep borrowed money for longer, growth rate rises more. If people suddenly panic about the level of debt they're in and decide to reduce their debt, the growth rate plunges And if banks slow down, well, then you can get negative. You can have a slump. Back up again, let's go back to the original situation once more. I'll make the repayment a bit slower, and let's look at the impact on the economy. You've had a boom and a slump, driven by an increase and then a decrease in the rate of growth of debt. That's all it takes to go from their fictional, false vision of the world to the real world. Okay? That's how ignorant economists are of the actual real world.
Did you just create a recession?
Yeah, but I solved it again by lending once more.
Oh, okay.
And it was all the good projects. No Ponzi scheme has got money then. Okay? Now, the remarkable thing is we know we live in a cyclical system. You're always talking about booms and slumps. How long is this boom going to last? When's the next recession going to be, etc., etc. This is the sort of discussion that goes on inside conventional economic academic circles. One of the remarkable conundrums in theoretical economics is the so-called business cycle. The existence of large persistent fluctuations, even for very large economies. And they say that which can culminate in crises like in 2008. They said, naively, however, the output fluctuations of large economies should be very small. They can't understand why cycles occur in the first place. And yet they're supposed to be advising us on this cyclical system. And it's this obsession with equilibrium, which is, again, their obsession with ignoring banks, debt and money. The obsession with equilibrium goes hand in hand with that. And this particular quote here is from somebody you might not know the name of, who's saying economic models adhere strictly to the importance of equilibrium as part of any theory. And he's actually quite a good bloke. I've met him. This is Ed Lazaire, who was Bush's chief economic advisor. Okay? So I'm not quoting somebody who's obscure here. And this is in a paper he wrote, published in one of the top 4 journals in economics, which had the actual title of Economic Imperialism, saying economics was the only science in the social sciences and it should take over the others. Well, heaven help us if they did, because they've stuffed up economics so much. Imagine what they do to sociology. Now, the real world, we're far from equilibrium, and we need a non-equilibrium economics, and it's not hard to invent. So here's a very simple model that I can explain in 6 lines of text, taken from work of a neglected but great economist called Richard Goodwin back in 1967. So roughly speaking, the level of capital you have determines the amount of output you can produce. And roughly speaking, the amount of output you can produce determines how many workers you need to hire. The number of workers you've hired determines the rate of change of wages. It's a classic Phillips curve argument, level of unemployment determining the bargaining power of workers and so on. Wages determine profits in this simple model because you've only got 2 social classes in this system, so output minus wages is profits. He simply had all profits being invested. And investment's the rate of change of capital. Now that is a cyclical model. When I run that in a simulation, I get this sort of cyclical growth. So to show you that in Minsky as well, it's exactly the same model I've mentioned. I've got productivity growth going on exponentially here, population growth the same, and I've got investment function down here as well. And I simulate that model and I get cycles. It ain't rocket science to get cycles in economics. It's a form of perverted rocket science to avoid them completely. And that's what they've in fact done. They've invented an incredibly difficult, really hard way of generating models that have almost no relevance to the real world, but exhaust their minds in setting those models up, make them think there's no other way that one can do economics, and they then reject a huge part of the real world that doesn't fit inside their theories. Now that's a cyclical model without debt. So what happens when you add debt to it? Well, you get the real world. That's what I did with my PhD thesis. So I simply added the fact that capitalists borrow money to finance investment, and they borrow money during a boom but have to repay it during a slump, and just added to that cyclical model I've got beforehand, so they pay a rate of interest on it, and went to see what happened. Again, this is one of the hassles about a low resolution screen here, so I've got to make it a lot smaller so you can actually see it. So I'll make it a bit larger here and just shift things around a bit on screen. So pardon the visuals not being so brilliant, but what you get is cycles that look like they're going towards equilibrium if you're a linear thinker. Only, notice the debt ratio here is rising, and this is actually workers' share of output, which is falling. You're getting smaller cycles in employment, which looks like it might be what you might call a great moderation. And then notice after a while, these cycles, which were getting smaller, this is employment versus wages share on the one graph, start to get larger. You go from a period of declining volatility to increasing volatility, and over here you've got a rising debt to GDP ratio. It can take all sorts of different shapes as it rises, but you'll just notice a few little pimples turning up there. As they start to get larger, the cycles in employment also get larger. And what's actually going on? The debt level is rising, being compensated for by falling wages share of output for a while, but ultimately the exponential increase in the debt ratio overwhelms how much workers' wages can be cut. And you get to the stage where you get the debt level goes through the roof and the economy collapses. And this is the model without bankruptcy, so you can't write the debt off, and without a government sector that can spend in the opposite direction. But that's the sort of crisis model that I built back in 1992, which made me rather sceptical when I saw the so-called Great Moderation happening about whether that was a good thing or not. So, but an incredibly simple model. I've only added to that, those 6 points I showed you beforehand, that capitalists borrow money to finance investment when it exceeds their profits. The desired investment exceeds profits. And they pay interest on the loan. That's all I've added to that model. I've got some nonlinear functions there to give you a bit more realism as well. But it gives you all the features we saw from the 1990s on. We had declining volatility for a while, which the conventional economists thought was a sign of their great management of the economy, and they called it the Great Moderation. Then you had rising volatility, which is what we're going through right now. There was a rising debt to GDP ratio, private debt, and rising inequality because the falling workers' share meant more inequality in distribution between workers and capitalists, which is the fundamental division in our society over the distribution of income. So that's, yeah. It's pretty easy, really. Just add banking. So that's a theoretical view of the world we're in. I want to give you a bit of an empirical about what are we going to face in the future, given where we've got to. Because we have a recovery going in America right now, but it's going to be limited by the sheer scale of debt. The red line is the ratio of private debt to GDP in America since 1950. You can see it's gone from being about 50% of GDP, which is its minimum level, up to 170% after the crisis, and it's now come down to about 145%. So you've had about a 35% fall in the debt to GDP ratio. But that ratio far exceeds anything in the post-war period, and it exceeds, when you use comparable figures, it exceeds the Great Depression level as well. And the blue line is the annual change in debt. You can see how volatile it is, and it does match the trade cycle. And then the crisis began, that's that huge plunge, and then for a while America's deleveraging at a rate of about 4% of GDP over here, and now they're back re-leveraging again. And that's a large part of why the American economy has recovered. The private sector is borrowing money once more, but still not quite enough to make this debt ratio rise. Okay, the figures have been changed just in the most recent, two recent releases of the flow of funds. They've redefined business debt and reduced it quite drastically from the 1980s on. We were working with very poor data when it comes to analysing debt, but that's the basic situation of the American economy. I can't ever see the change of debt levels getting back up here again. And that would give us a boom, but if it did, it would also blast the debt level well past where we got to in the peak of the last crisis. So I think that the length of time for which the American economy can go on a debt-led growth binge is limited. I wouldn't give it more than 5 years. Whereas the last boom went from 1992 to 2007, I think this one will have its comeuppance in the next 5 years or so. I could be wrong on timing there, but I simply can't see this getting up to anything like the previous level before you start to see it turning down again, which means negative changes in debt, taking money out of the economy and slowing the economy down. And the stock market, this is not a correlation that I expected. Okay, it was a surprise when I saw this one. This is the ratio of margin debt to GDP on the left-hand side, which is the red line, and the S&P 500 on the right-hand side, just without allowing for inflation over all those years. But you can see we have had 3 peaks of margin debt and 3 stock market peaks. So I think, how much higher can stock and margin debt go? It's already back to the peak that it was, pretty close to the peak, but it reached back in 2000, the bust then. Then we had another one, then we got another one. And look how margin debt back in the 1980s was down at about 0.5% of GDP. It's been averaging about 2% of GDP all the way through the 2000s. So the level of leverage is what drives asset market behaviour. This is the correlation I did expect. This is the correlation of the acceleration of margin debt and the change in the S&P 500. It's a bit of a leading indicator. So the argument I make goes from saying that change in debt drives aggregate demand and aggregate income. So the acceleration of debt drives the change in aggregate demand, and it also drives change in asset prices, because a large part of the money being borrowed is borrowed for speculation on asset markets, it's not borrowed for production. Well, that's the correlation, which I think is about 0.6 or so over the last 15 years between acceleration of margin debt and change in an annual basis in the S&P 500. Now, that margin debt acceleration has been trending downwards for quite some time. So I've got a feeling at some point it'll start asserting itself on the market. QE's muddied the waters quite dramatically, because QE has certainly helped inflate asset markets. It's a phenomenon that hasn't been there before. But even so, that correlation is still moderately holding. I think it'll get stronger as QE gets removed over the next year. So I wouldn't expect the stock market to go too much higher, and I'd expect a lot more volatility next year than this year. The Euro region, of course, is the basket case of the global economy. And this is an indication as to why. Most people think that because the Europeans focus on the level of government debt, on austerity and so on, everybody's focusing on austerity and saying they're not doing it hard enough. Well, they're doing it too much. But it's not actually austerity itself that's doing all the damage. It's what austerity is doing to the private sector. Because if you have a government taking money out of the economy, which is what a government surplus does, then if you're in debt in the private sector, you haven't got the cash flow coming in. The government's actually reducing your cash flow. So you're going to try to, you want to do one of two things. You're either going to go bankrupt, okay, which does reduce your debts, or you're going to deliberately pay your debt down. Now, the rate of debt reduction in Spain is simply mind-bending. The rate at which Spanish private debt is being reduced is equivalent to more than 20% of GDP per annum. Now, that would be rapidly reducing their debt ratio, but for one thing, and that's the GDP is falling not at quite the same speed, but pretty damn fast as well. So as fast as they're reducing their debts in nominal terms, the GDP is also falling in nominal terms. The ratio is not declining all that much. Remember that steep downwards decline in change in debt and then steep rise I showed you for the American data a few slides back? The red line is exactly that same data. It's stretched out a bit because of the shorter number of years I'm looking at. But look how little deleveraging occurred in America versus the scale of deleveraging in Greece and Spain. And that's what's really driving the depths of the European downturn. So if we're ever going to have a real recovery, what do we need? We have to drastically reduce private debt. Private debt getting out of hand is what caused the false asset market bubbles and booms in the economy before the crisis, and then the slowdown of the rate of change of debt caused the depth of the crisis we've been through. We have to eliminate private debt. And my proposal has always been what I call a modern debt jubilee, where you use the capacity of the government to create money and do what people actually think QE is doing, which is money printing. It's not. It's printing reserves for the banks. It's not printing money that gets into the deposit accounts that we have at banks at all. But if it actually did that, I'd do it with the link to requiring anybody who had debt, who got a government injection of money, would have to pay their own debts down. They couldn't hang on to the money, which would mean, therefore, that you're not favouring debtors over savers, because you'd get the injection irrespective of whether you're in debt or not. But if you were in debt, you'd have to pay your debt down. If you weren't in debt, you'd have cash which you could spend into the economy. So you try to minimise the negative impacts of the policy on the level of economic activity. And it also demonise having an expansionary fiscal stance. That's a very verbose way of saying what I want to argue here, but we normally have the fiscal policy being seen as